Happy Monday. So last week, not a lot of economic news out, but the good news from last week was the fact that the 10-year Treasury was able to fall below 4.5% and drift a bit lower from there. That's good news as far as the trend goes. 4.5% is kind of a technical level. We certainly don't want to see the 10-year bounce above that. But unlike last week when we had very little economic news, this week we've got the Fed's favorite gauge of inflation coming out. That's the PCE, or the personal consumption expenditure. And as you can see in the graph, the last couple months, the trend is not very good as we have hit 2.6%. We're kind of looking like going into the end of last year that the Fed's favorite gauge would be drifting lower, and it has made an about face here. So this week's number is certainly an important market mover. Hopefully we come in maybe a tenth below last month's. That'd be a nice little sign for the market. Maybe we get interest rates moving lower still. What does that mean for our mortgage interest rates? Well, each of the last couple of weeks, we've moved just a tick or two down in overall rates. So Freddie Mac's primary mortgage market survey is showing that the 30-year fixed rate sits at 6.85%, slightly lower than 6.87 last week. Again, this last week, not many news items out there to really move the market. This week, in addition to the PCE number, we have GDP, so two really big market movers. We'll give you an update next week after these numbers come out. Keep your fingers crossed. A couple good prints that the Fed may like could result in a move up from their end of the year target to cut their federal funds rate to maybe something sooner. There is a couple wirehouses out there and market analysts that are starting to chirp that maybe the first cut will come in July. These numbers that we get out next week certainly would give us an indication if that may come true. We'll talk to you next week.